Hello and welcome to this lecture, which is a Finance Act 2013 update. Now, this lecture is aimed at students who are sitting their exam in May and November of 2013. And we've tried to make the lecture as relevant to as many students as possible. So we're looking at all the new things and maybe the things that have changed following the Finance Act 13. But not all of those new things might be in the paper that you are sitting. So I want you to have a bit of caution, have a look at what's in your syllabus, and where there's a topic that I'm covering in the lecture that's not relevant to you, then just bear with it. I mean, hopefully enjoy it. But just always keep it in mind, what is the paper you're sitting and what's in its syllabus. Now, I'm going to start the talk by having a look at corporation tax and business tax first. And that's what we'll be looking at in this lecture, which we've called Part 1. So the first thing to notice is that corporation tax rates at the full rate have been going down. They're going down year on year on year. Small profits rate, is staying at 20% throughout. So the first issue for us, those of us sitting the OMB paper, the ATT paper, ATT paper 2, also the more advanced corporation tax paper, paper 3, is that you're going to have to watch out for straddle periods. Because if you've got a year ended June, a year ended December, you're going to have some of your accounting period falling into one of the rates of corporation tax and the other falling into another rate of corporation tax. So that means that you're going to have to time apportion your TTP to tax it at the main rate. And then, of course, if you're into marginal relief, you're going to have two completely separate marginal relief calculations. Now, this is all very exciting for our examiner. He really loves having straddle periods like this. So, again, you've got to make sure that you've worked some numerate questions and you're able to do those sort of calculations fairly quickly. What else have we got going on? Well, the annual investment allowance, that's been changing a lot over the years. It was 50,000, and then in April 10 it went up to 100,000, and then in April 12 it was reduced down to 25,000. Well, now it's increased again to 250,000, and this is for each of the calendar years, 2013 and 2014. So it's going to start at 1 January 13 that it goes up to this 250 limit. The plan is, after the 2 years, it will go back to the 25,000 limit it was at before. Now, there are some transitional rules that we obviously need to be aware of. The amount that we're going to claim for our business is going to have to be time apportioned if your accounting period is going to straddle one of these changes in the rates of AIA. So the first thing is you're going to have to work out time apportioned AIA, but it's a bit more complicated than that, because we have to be very careful about the date of the addition. So what date is the addition of the plant and machinery that we want to be claiming the allowance on? Now, the normal rule for timing when it comes to additions is that the expenditure is incurred on the date on which the obligation to pay becomes unconditional, and for most intents and purposes, that's the date of delivery. However, we do have something called the 4-month rule, and so if there's more than 4 months between the date on which the obligation to pay becomes unconditional, i.e. the delivery date, and the date on which the payment is required to be made, then the expenditure is not incurred until the date on which the payment is required to be made. So if I have an item delivered but I don't have to pay for it till 6 months later, the addition is not the date of delivery, but rather the date I pay for it in 6 months' time. Completely different rules for HP contracts, because with HP contracts you're paying in instalments over a number of years. So if you're buying an asset on HP, the addition date is the date when the asset is brought into use. So we need to take a lot of care in the exam about our addition dates. Can't just go with invoice dates. Really need to look at delivery dates, but then you also need to look at payment terms. So it can be a little bit more complicated, but the examiner, remember, will have to give us all of that information in the exam. It's just we're going to have to read through the information we've been given and make sure we pick the correct date. So let's say that in the exam I'm given the year ended 30 June 13. Now, what we've got with this accounting period, we're thinking about a company in this example here, but it'll be equally the same for sole trader or a partnership, is that we've got 6 months when the AIA was 25,000 and then 6 months when it was 250,000. So we're going to do our time apportioned calculation and we're going to get ourselves to a grand total of 137,500 of AIA. So we'll sit there thinking, wow, brilliant, that's my total. But it's a bit more complicated than this. So this is your maximum AIA, but you may not be able to get the maximum AIA depending on when you have incurred the expenditure. Because any expenditure that you've incurred whilst the AIA was 25,000, so that's before the 1st of January 13, that expenditure is going to be relieved on the basis that the AIA didn't go up to £250,000. So here we are with our apportioned maximum of 137,500. The timing issues basically are in that first 6 month period of that 137,500, the maximum expenditure on which I can claim an AIA is going to be £25,000. The balance of the AIA, well, that can be relieved against expenditure in the latter 6 months for this accounting period. If all of my expenditure was in the last 6 months, then I can claim 137,500. The issue is when I've purchased anything before the AIA went up to 250,000. And so, as a summary, the maximum expenditure on which you can get AIA, where you made the addition before the 1st of January 13, is £25,000. The balance of whatever time apportioned AIA you've worked out is what you can then claim against expenditure in the 2013 tax year. So again, this apportionment, this changing of the AIA is looking highly topical for us doing corporate capital allowance comps in the exam. A few other things to remember. AIAs are available to all UK businesses, including property businesses and large corporates. Sole traders and partnerships have one AIA each, so if my sole trader had more than one trade, he has to choose how he wants to allocate his AIA over those different trades. A 51% group of companies, as I will call it, are treated as just one for AIA purposes, so they have to share the AIA around the group as they see fit. Also, companies under the control of one person are treated as just one for AIA if they are related to each other. And related means that they're carrying on a business on the same premises, or more than 50% of their turnover is derived from the same activity, that sort of thing. The one other thing to watch out for is that partnerships that have a corporate partner get absolutely no AIA whatsoever. So that's our AIA. Now, with the Finance Act 13, two new things were brought in which are aimed at smaller businesses, sole traders, partnerships, to help make life just a little bit easier for them. The first thing is called cash accounting. So it applies from our tax year, 13-14 onwards in the exam. As I've said, it's income tax only, so you're just looking at sole traders, partnerships. And it applies to those traders if their receipts are below 79,000 in the tax year. Now that's the VAT threshold, the registration threshold for VAT. So if they're below that threshold, then they can go into cash accounting if they want. It's entirely optional. And if you are, you just tick a box on the return and hey, you're away with cash accounting. The other scheme is called the flat rate deduction scheme. Again, it applies to any unincorporated business. Again, it's completely optional, and it's completely independent of cash accounting. You could do it with cash accounting or just on its own, and you don't have to adopt all of the different flat rate deductions that are being mentioned in this new bit of legislation. So two new areas for us to be aware of. Now, how could this crop up in the exam? Well, maybe we actually have to apply these new rules, or maybe we're writing a letter to the client telling them about one or other of the new rules and how it might or might not be appropriate for them in their business. So let's start off with cash accounting and have a look in more detail about the new rules there. As I said before, your business is eligible to go into this cash accounting scheme if you are not exceeding the VAT registration threshold. Now, to decide whether you're exceeding that threshold or not, we're looking at our normal current year basis principles. So if my income is for the year ended July 13, current year basis ends in 13/14, my turnover is 50,000, that's less than 79,000, so in 13/14 I can, if I wish, use cash accounting. And once I've elected to go into cash accounting, the election applies for my current year and subsequent years. However, as my turnover gets bigger and bigger and bigger, there's going to come a point when I'm not allowed to use cash accounting anymore. And so cash accounting ceases to apply to the following year where your receipts exceed 158,000 in the current year. So let me give you an example of this. If my income in the year ended July 14 is 100,000, then July 14 is 14/15 current year basis. 100,000 is below 158,000. I'm okay, I can stay in cash accounting. Next year ended July 15, current year basis 15/16. Now my turnover is 170,000, so I've exceeded the 158,000 limit. So I can stay in cash accounting for this year, 15/16, but for next year, 16/17, I've got to come out of cash accounting and go into the normal rule, which is prepare your accounts on an accruals basis. Unless, when I get to 16/17, I've had some sort of catastrophe and my turnover is below the then VAT registration limits of 79,000 equivalent, when, of course, I can be in cash accounting under the normal rules. Now, these limits that we've been looking at, they are adjusted if your basis period is less than 12 months long. You can also cease to apply the cash accounting basis by election if it's more appropriate for you to follow the accruals basis of preparing your accounts. So, how does cash accounting work? Well, before we go into how it works, can I just say that that 79,000 limit applies to the combined receipts of all your unincorporated businesses. So if I was a sole trader with several different trades, I've got to add all my different trades turnovers together when I'm looking at those limits. And if I decide to use cash accounting for one trade, I've got to use it for all my little trades as well. It can't be used by companies, and it can't be used by partnerships if the partnership has a corporate partner. Also, especially relevant for those of you doing paper 2 at ATT, the election cannot be made if you want to claim farmers averaging or you're looking at the herd basis. What you're doing for income tax is also what you'll be doing for Class 4 NIC. So whatever basis you're using, cash accounting or accruals basis, the profit you're going to tax to income tax in a tax year is that same profit that you will use to work out Class 4 NIC. Okay, so there's a few little extras I wanted to mention. Now let's have a look at how the cash basis works. And basically, it's as it says, it's what it says on the tin. So you basically only consider the amount when it's received, that will be your income, or when it's paid, that will be your expense. So nice and straightforward. And so if I buy plant and machinery, then I'm paying out money, that's an expense. Cash basis says put that expense through. And so what that's going to mean is there will be no capital allowances available when you buy plant and machinery. And the other side of the coin is when you sell the plant and machinery, then you will bring in the sale proceeds from the sale as income. Now, having said that, there's a special rule for cars. Cars do not follow this rule. Cars continue to have capital allowances on them. So you will continue to claim capital allowances on cars. There's also a special rule when it comes to interest paid on a loan and also any incidental costs or obtaining loan finance. These expenses can be deductible, but only up to a maximum of £500. If my income is much less than all of my expenses, then I will have made a loss. Now, under cash accounting, that loss just goes forward to the next year and is an opening payment in the following year. So you don't have the options that we have under the accruals basis of preparing your accounts, the normal rules, where you will look at all the various different loss reliefs available. Under cash accounting, basically that loss just goes forward to next year and is an opening payment in the year. Now, you are going to have to make some adjustments if you want to come into the cash basis in 1314. Because if you've been preparing accounts in the normal way, using the accruals basis, and suddenly you want to come into the cash basis, you're going to have to make some adjustments. So when you start using cash accounting the first time, you have to make these adjustments to avoid double counting. So to avoid counting your income twice, your expenditure twice. Because under accruals, I will accrue for an expense before it happens, and then if the next year I'm in cash accounting and I actually pay the expense, I will have put that expense through twice. So we really want to avoid that sort of thing happening. Any unrelieved capital allowances in your business are just brought in as an expense on that first day of cash accounting. But remember, not cars. With cars, you're going to continue to claim capital allowances. Now, if there's no private use of your car, it's going to be in the 18%, the general pool, or the 8%, the special pool, depending on its emissions. You might have other stuff in that pool as well. So what you have to do is use a just and reasonable basis to take the other plant and machinery out and put that through your accounts into the cash basis, and then just leave the cars behind where you will continue to claim capital allowances. If the cars have private use, then they'll already be in their own separate column, so you won't have to make any adjustments. You'll just carry on claiming capital allowances on them in the normal way. When finally you leave the cash accounting scheme, then your debtors plus your stock less your creditors, that amount is treated as income for your accruals business. So that's income in your next set of accounts you prepare under the accruals basis, although there are special rules to allow you to spread that income to tax over the next 6 years. Okay, so that's the cash basis. Let's have a look now at our next slide. We're now going to have a look at the flat rate scheme. Now, under the flat rate scheme, various expenses that an unincorporated business might incur are going to be treated slightly differently if the trader so chooses. So one of those expenses is motor expenses. And basically, what the trader can do is they are allowed to claim 45p per business mile for the first 10,000 miles, and then that goes down to 25p per mile after those 10,000 miles are up. There will be no other relief available, so no capital allowances on the use of the car, no lease hire deductions. This is the only deduction you're going to get in respect of motoring expenses and your car. And that means, of course, no capital allowances will be allowed on the car as well. Now, this new scheme will apply to cars bought in 1314. And once you go for the flat rate scheme in respect of your car, you're going to have to stick with the flat rate scheme on that car from now on. So that's the first one, to do with motor expenses. The second flat rate scheme is to do with using somewhere, a part of your home, as a home office. And the amount of deduction you get depends on the number of hours you work in your home in the month. So 25 hours or more, I can have £10 per month. 51 hours or more, £18 per month. 101 hours or more, £26 per month. Now, the use of these amounts is completely optional. The Alternative, the thing we do at the moment, or prior to this scheme, the thing that we used to do, was we would get our trader to sort of make an estimate of all the additional costs of having a home office. Here, much simpler, don't have to keep all the paperwork and the justification of the expenses, you just get the flat rate scheme. So, for example, let's have a look at Helen. An accountant working from home, she dedicates a room for business as her office between 9 and 5 daily, but let's say she only uses it for 4 hours a day. During the evening, family are using it for a few hours per night. Now, at the moment, she has a £200,000 mortgage on her home where she's paying 4% interest. She's got 10 rooms in her house, of which the home office is one of those rooms. She's got some other expenses, council tax, insurance as well. Now, under the flat rate scheme, she's working what? 4 hours a working day, 5 working days a week, 20 hours a week, let's say 80 hours a month. That's more than 51 hours, so she's allowed to claim her £18 per month deduction. So for 12 months, 12-month accounting period, so she can deduct £216 from her accounts as an expense to cover the use of the office at her home. Now, what we would normally do with Helen is we'd say, okay, Helen, what are all your associated expenses? So let's get the mortgage interest, the council tax, the home insurance, £11,000 for your whole home, 1/10 of that is your home office, so we're looking at 1,100, but let's sort of only take the business use of the home office type thing. So here I'm estimating that that's about £880 of that cost, and then don't forget the heating and the lighting of the home office when you're using it. So normally we'd be getting, what, a much better claim, 1,100, as opposed to the 216 we're allowed under the flat rate scheme. Now remember, the flat rate scheme is optional. No one's telling you you have to do it. I think you'd really have to do the maths if someone did have a home office to see if it was worthwhile for them or not. But of course what you are also weighing up is that under the flat rate scheme you don't need to have all the evidence, you don't need to have all the paperwork to support the claim that normally a sole trader would have to make. Okay, so those are those two new schemes. Let's have a look at another new scheme which ties in with research and development. Now, just a little bit of a reminder, if I'm a small or medium-sized enterprise, so I've got less than 500 employees and my turnover and balance sheet amounts are below certain limits, then I can have 225% relief on my qualifying research and development spend. But if I'm a large company, I don't get that. I only get 130% relief. Now, the government are sort of phasing the 130% relief out. And so from the 1st of April 13, there's an alternative to this 130% relief. And this is going to be what we're going to call an above-the-line relief of 10% on qualifying expenditure. And I'll show you how that works with an example in a moment. Between April 13 and the 1st of April 16, companies have got a choice. They can choose between this new method or the old 130% method, but from 1 April 16 onwards, the 130% method will not be there anymore. So we're going through a bit of a transition here. Now let me give you a comparison. On the left-hand side, you've got the normal treatment we're used to, the 130% deduction. So if I've spent £1,000 on R&D, or £1 million as it is in this example, then I've put 100% of it through, so I'm allowed another 30% of it through as my extra deduction. Now in this example here, that would get me to 100,000 of taxable profits. Let's say full rate applies, 23%, 23,000 of tax. Under this new scheme, what we're going to do is above the line, we're going to take 10% of the qualifying spend. So 10% of the qualifying spend is £100,000, and we're going to add it on above the line as extra income. So that's going to make us have 500 profit. That's what we tax at 23%, but then the above the line income becomes a credit off the tax that we've worked out as due. So 100,000 comes off our 115,000 of tax, giving us net tax payable of £15,000. So you can see that in this comparison here, we're much better off using the new method. Another brand new thing brought in by Finance Act 13 is disincorporation relief. Now, disincorporation relief is going to run from 1 April 13, and basically it's where we have a company and it doesn't want to be a company anymore. You want to trade rather as a sole trader or a partnership. So it's sort of the opposite to incorporation, it's disincorporation. And so what's going to happen is the shareholders of the company, or some of the shareholders of the company, are going to run the business as a partnership, or maybe single shareholders going to run it as a sole trader. Now, disincorporation relief will apply in that scenario where the market value of your qualifying business assets do not exceed £100,000. Now, your qualifying business assets are property, land and buildings, and goodwill. And what disincorporation relief says is if the value of all those assets are below this 100,000 limit, then they can be taken out of the company and there will not be a corporation tax charge on the company. So they will be extracted at the lower of cost or market value. And so let's say we have a building, it cost 80,000, its market value is 90,000. It will be extracted at the cost of 80,000, take off the cost of 80,000, oh, no gain. And so by having no gain, you have no corporation tax on the extraction of that asset. And that's what the relief is all about. The sole trader, the partners, the base cost of the asset extracted is equal to that deemed transfer value. So again, that lower of cost or market value. So the sole trader going forward will have presumably a much lower base cost in the asset, so when he sells it in the future, he will have a much bigger gain. Now, the relief only applies to asset gains in the company. It means there's no asset gain in the company, there's no corporation tax. It doesn't cover anything else. And the anything else I'm thinking of is if a company distributes an asset, gives an asset, sells an asset to a shareholder at less than market value, so that's like a dividend in specie, then the freebie element, the difference between market value and what they're paying for it, is a dividend, is a taxable dividend on that shareholder. That will still happen. And so there they are with a bit of a dividend, and they are now owning an asset with a quite reduced base cost, hence a bigger gain in the future. So you're looking at a scenario where there could be a double charge to tax. So that's something you're going to have to weigh up before you recommend this in the exam. So, lots of conditions. The first thing is that the company is transferring its business to some or all of its shareholders, and that transfer is a qualifying business transfer. Now, lots of conditions to satisfy there. You've got to be transferring your business as a going concern. The business is being transferred with all of its assets, although you are allowed not to transfer cash. The aggregate value of goodwill and property does not exceed £100,000. All of the shareholders to whom the business is transferred are individuals, and each of those shareholders have held their shares for at least 12 months. You don't have to be distributing the assets to each individual shareholder. You can sort of only be transferring it to some of the shareholders. The business transfer date needs to fall in a 5-year period from 1 April 13. So this is going to be a bit of a limited relief. It's only going to be around for 5 years, and then it's going to go. The relief must be jointly claimed by the company and the shareholders to whom the assets are being transferred. So let's have a look at an example. We've got a company, and inside the company, the market value of the property and the goodwill is less than £100,000. And so what's going to happen is we want to disincorporate this business, pass those assets to Padre because he wants to continue the business as a sole trader. Now, this goodwill, this property would normally generate a chargeable gain if they were transferred to this connected person, because normally you'd say transfer at market value, work out the gain. If there's a gain, there's a corporation tax liability. But if you claim disincorporation relief, then there will be no gain, so there will be no corporation tax liability. Any funds inside the company that are then distributed to Padre in a form of winding up are a capital distribution, which is a gain for Padre in selling his shares, and this rule is always there whether or not disincorporation relief has been claimed. The other thing you have to remember is Padre now acquires the property and the goodwill at a low base cost going forward, but I think we're hoping that he can run the business, and when he comes to sell those assets in the future, if he sells the business as a whole, he'll qualify for entrepreneur's relief. At least I think that's the aim. Okay, a few more things I want to say. Capital allowances again, capital allowances on cars. I just want to point out to you that the emissions for cars are going down, 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 down. So it's going to become more and more cars will be falling into your high emission pool. So emissions are going down, 95 grams per kilometre, 75 grams per kilometre. And so if you're looking for very low emission cars, those of you who are interested in that sort of thing, that's what I've put this slide in here to show you. Your choice of low emission cars is getting smaller and smaller and smaller as they bring the emissions down. With cars, remember, it's 18% writing down allowance for cars in the general pool and 8% in the special pool. And to determine whether you're in the general pool or the special pool, we used to have a 160 gram per kilometre limit. That's now been reduced to 130 grams per kilometre from April 13. So just something to watch out for there. But remember, it's all in your tax tables in the exam. You should just be referring to your tax tables, not really learning this sort of thing. What else have we got? Okay, loans to participators. Now, this is an important topic when it comes to close companies. So that's a company under the control of 5 or fewer shareholders or any number of shareholding directors. With a loan to participators, something happens, which we'll look at in a second. The Finance Act 13 has basically broadened the definition of what we mean by a loan to a participator. And this takes effect from the 20th of March 13, and it brings into the definition loans to partnerships and trusts and transfers of values that are not loans. So when we have a loan to a participator, we have a thing called penalty tax, section 455 tax. This is now going to start to apply in more situations. There's also a special rule to stop a bit of avoidance that was going on, where we would bed and breakfast these loans, and that's been brought in as well by the Finance Act 13. So we're going to look at both of these things. But let me just remind you what this penalty tax is. If a participator has taken a loan from the company or has an overdrawn loan account at the end of an accounting period, then we have to consider this penalty tax. And so what we do is we look at the amount outstanding at the end of the accounting period or at the normal due date, which for small, medium-sized companies is 9 months and 1 day after the end of the accounting period. And we look at the lower amount outstanding on those 2 dates. And that times 25% is an amount of penalty tax that the company will have to pay. Now, it's not an annual charge. It's on loans as and when you take them out. So let's say we have a year end of December 11, and we look at the balance outstanding at the end of the accounting period. We look at the balance outstanding on the normal due date. So normal due date there is 1 October 12. The lower of the two says £20,000 is outstanding, loan to participator. So at 25%, £5,000 of penalty tax will be paid. If the amount outstanding then increases up to 30,000, then this participator has taken out another £10,000 of loan. So at 25%, there will be an extra $2,500 of penalty tax due next October 13. So you're not looking at the amount outstanding at the end of every year. You're looking at the loan and whether it increases, etc., during the year. Now, when the loan is repaid or the loan is waived, the penalty tax is repaid to the company. That repayment is due 9 months and 1 day from the end of the accounting period in which the loan is repaid or waived. So that's the normal rule. Now, what's new? Well, after 19th of March 13, the definition of loan is an awful lot bigger. So we're now going to include loans to trustees, or one or more of the trustees, or the actual or potential beneficiaries of the trust is a participator in the company. So loans to employee benefit trusts owning shares in a company were actually already caught under the old rules. Now they don't even need to own shares to be caught. Loans to a limited liability partnership or another partnership where one or more of the partners is a participator in the company. Loan from a corporate partner to the partnership was not previously covered by our old Section 455 rules because it was not a loan to the other partners. Well, we've now extended the definition to say, right, it's caught. We're also looking at other payments because Section 455 only covers loans or advances. We've now got a new Section 464A to cover much more situations. And basically, those situations involve partnerships where there is also a corporate partner. So much wider definition of the sort of things that are caught now to penalty tax. So just be aware and cautious of those changes. The other change is to stop something that was happening, which was called bed and breakfasting of these loans. And so we've got now a new little bit of the legislation to counter that. What was happening was, what's really important is how much of the loan is outstanding when you get to normal due date. So if you paid your loan back by the normal due date, nothing was outstanding, no penalty tax, and then what was happening was you would, once that normal due date had passed, take out the loan again. And so we were finding that people had borrowed money from the company for most of the year, but because they'd paid it back for a very short period, which included the normal due date, they were not triggering any penalty tax. And this was called bed and breakfasting the loan. And of course, the revenue wanted to put a stop to this. So you're looking for a scenario where the loan is overdrawn for a significant part of the year, but they are managing to avoid the penalty tax charge because they're paying back the loan just for a nice short period of time. So the new rules say, right, we're going to stop this. And so relief will not be given where more than £5,000 of the repayment is reversed within 30 days, or the loan is more than $15,000 and there is an intention to make a new payment at any time. So this isn't tied in to a 30-day period. So it's effective in relation to repayments and return payments made on or after 20 March 13. Now, if the repayment of the loan takes the form of income that's chargeable to income tax on the borrower, then the restrictions don't bite. And, of course, one of the common ways to clear a loan is the company pays a dividend to the shareholder, the participator. Well, if he uses that dividend to repay his loan, then that's fine. He genuinely has repaid his loan. So, I want to work through a little example with you. A Limited is a company, closed company, in which Ian is a participator, and the company has a 31 March year end. Now, on the 25th of March 2013, Ian borrows £15,000 from the company, and on the 1st of December 13, the company declares a dividend of £9,000, and that's set off against Ian's loan account. So that is him really repaying back £9,000 of his loan. on the 1st of December 13, Ian also repays his loan balance of £6,000. So 15,000 loan, 9,000 repaid using the dividend, 6,000 actually repaid by Ian. Looks like he's completely repaid the loan. And so by the time we get to the normal due date, which is the 1st of January 14, there'll be no loan outstanding. But after repaying his loan, on the 10th of December 13, he borrows $3,500 from the company, and on the 15th of December 13, he borrows another $2,000 from the company. Okay, so we're now looking at $5,500 borrowed from the company. So he repaid $6,000 of the loan, which is more than $5,000. But within 30 days of that repayment, he then borrows another $5,500, which again is above our 5,000 threshold. So the original loan was in a different accounting period to these repayments. What we're going to say under the new rules is we're only going to say he repaid 5,000 of that loan, not the 6,000, because he then went and reborrowed 5,500 from the company. So only 5,000 of that loan repayment will be recognised. So only £500 of that loan repayment will be recognised, which means when we get to our normal due date on the 1st of January 14, we think there's 5,500 of loan outstanding. And that's what we work out the penalty tax on. Now, before this new rule came into play, we would have said there was no loan outstanding on the normal due date, and we wouldn't have had to worry about penalty tax. But now, because of our new rules, because of him basically taking out a loan again within 30 days to, if you like, refund the thing he then had to pay back to the company, so we're sort of matching these things together, it won't work anymore. Another scenario, let's have a look at this one. Tom is a participator in B Limited and owes the company $25,000, which he drew on the 1st of June 13. The company has a 30 June year end. Now, normal due date is 1 April 14. Just before that, Tom borrows $25,000 from the bank and pays off the loan. And so, great, by the time we get to normal due date, no loan outstanding, no penalty tax. 31 days later, he draws $30,000 from B Limited and settles the bank loan, and has an extra £5,000 to spare for himself. His original $25,000 repayment is going to be ignored, because this is the other scenario where there would appear to be an intention to withdraw the money from the company again. And so Section 455 penalty tax will be due on the £25,000 loan. We will say that that is effectively still outstanding on the normal due date. So in our exam, we're going to have to look out for scenarios where this is happening. Maybe we're being told by the shareholder he's planning to do this, or what will be the effect if he did this, and we will have to talk about it in a letter. So it could come up as a calculation. You add it onto the penalty tax, gets added onto the corporation tax for the period, or more likely than not, you have to talk about the consequences. Right, what else do I want to say? Group relief. Group relief can only be claimed between group companies for current year losses, and that's between a surrendering and a claimant company. And if those companies have got different chargeable accounting periods, you have to time a portion, because we want the loss, the current loss, to be matched against current profits made at the same time. What can you surrender? Normal rules for loss relief are you can surrender trade losses, non-trade loan relationship deficits, excess qualifying charitable donations, excess UK property business losses, excess management expenses, excess non-trading losses on intangible fixed assets. So a whole variety of things that you can surrender. Now, what's happened with Finance Act 13 is when you look at that list there and you're looking at the ones that say excess, that definition has slightly changed. Before the Finance Act 13, or rather prior to 20 March 13, excess meant the amount above gross profits of the surrendering company prior to any losses, including brought forward losses, being set off. The change, and this change will probably only affect those of you who are looking at the ACT paper, is that from 20 March 13, it refers to amounts in excess of the profit-related threshold. Now, this threshold is the sum of the surrendering company's gross profit, so that's just what we've been looking at before, but also any controlled foreign company profits that have been apportioned to the surrendering company. So if there's a controlled foreign company element going on in there and our company has had some of its profits apportioned to it, that's going to affect these excess amounts that can be group released. Right, thank you for sticking with me. That was part 1. If you come back in part 2, we're going to move on and have a look at the personal income tax aspects of the Finance Act 13. I hope you found this interesting. I hope it's made you want to go away and look into maybe more detail at those topics that are specifically relevant to you in your exam. But whatever, wish you all the best for your exams and I hope it goes well.